No, you know what we're really focused on today is the off-price retailers. You mentioned TJX, Ross Stores, Burlington. And the reason for this, they're market share gainers. They did great on the top line last year, but they really got hit by supply chain cost pressures. What we see differently this year is we see them actually starting to reap the rewards of some of those supply chain issues. You were speaking with an earlier guest about how the supply chain's still not moving. Think about those 100 ships sitting outside the port of LA, and think about the 6, 8, 10-week delay in getting those containers unloaded. By the time they're unloaded, they're probably too late to head to retail stores. And that's where off-pricers really get the best deals. So what we would expect as the year goes on for the off-pricers is they will start to see some of these elevated supply chain costs wane toward the back half. But at the same time, they'll be getting the benefit of great deals on great branded product from this liable product sitting outside the ports. I think it creates a really nice sales opportunity and further expansion and market share gain for this particular subsector within retail.
How much upside do you see for these three in particular, for TJX, Ross Stores, Burlington?
We see pretty substantial upside to the stock, between 30 and 50%, depending on the name. And really that will be making up some of the lost multiple. They're trading at a discount to their 10-year relative multiples versus the S&P. So we think that can bounce back after 2 years of underperformance. And we also see the opportunity for some nice earnings beats in the back half as they start to bring some of this really well-branded, sharply priced product into the stores.
So we're showing the multiples right now. Burlington, 27 times forward earnings. TJX still up at 22. How does that stack up historically?
Historically, they've tended to trade higher. For TJ and Ross, into the mid-20s in years when they're growing their earnings in the high single or low double digit. Burlington tends to trade higher because it has a higher growth rate and a longer runway for earnings and margin expansion. So they are all trading at a discount. And I think the reason for that is because they've faced some pretty severe cost pressures. When you think about off-price, they do handle the product a lot. It's not as efficient as a full-price retailer. So because of that and the fact that they charge lower prices for these goods, it hurts them a little bit more on the gross margin line. That's what we think we'll start to see ease as the year progresses this year. And that's where you'll see some of the really nice earnings upside opportunity.
Very interesting. So let's expand it a little bit maybe to the rest of your coverage universe. What about the rest of retail as we enter 2022? Is this going to be a year of differentiation?
I think it will. I think we'll go back to the typical cadence of a stock picker's market. The sector I cover is one of the least correlated within the S&P. They generally all did well last year because you saw that pent-up demand and the real consumer rebound in goods spending. We think it will be a little more nuanced this year, especially since we've seen many retailers hit margins well above pre-COVID levels. The supply chain had a different impact for some of the other retailers, meaning they had much less inventory than they would have liked. And as a result, they sold through a lot more goods at full price. So you're entering this year with sales fully recovered and gross margins well above where they were pre-pandemic. We do expect, for the most part, margins to come down for the full price retailers in 2022. And that's one of the key differentiators versus off-price, where we think by the back half, those margins will be going up.
Very,
so I think it'll be a little bit of a tougher year.
Yeah, and watch those margins. And like you're saying, they're falling in much of retail likely, but not in this niche. Very interesting point, Lorraine. Thanks so much for joining us today. It's good to see you.
Shepard Smith here. Thanks for watching CNBC on YouTube.